Imagine spending like 20 years of your life building a 5 million rand business.
Yeah, it's a long time.
Right, just pouring every spare hour and every spare cent into it, and then you lose absolutely everything you've built on a random Tuesday afternoon.
Oh, wow. Just like that.
Just like that, all because of one aggressive supplier lawsuit. It is a terrifying scenario, and it happens every single day in South Africa.
It really does.
And the drive that makes someone a successful entrepreneur often blinds them to their greatest financial vulnerability, which is holding their hard-earned assets in their personal name.
Or inside a trading company.
Exactly. It is essentially walking a financial tightrope without a net.
That vulnerability is, well, it's incredibly common. The fundamental mistake business owners make is blending personal ownership with business liability.
Which is so easy to do when you're just starting out.
Right, but when your commercial property, your share portfolio, and your operating business are all legally tied to you as an individual, you're putting your entire generational wealth right in the line of fire.
One unexpected liquidation or, a SARS audit, and it's all exposed.
Exactly. Right in the line of fire.
Which is the exact reason we are doing this deep dive today. We are going to show you how to build an asset protection fortress.
I love that term.
It's a great concept. We'll be exploring the immense strategic power of having a properly structured trust in South Africa.
But we're taking it a step further, aren't we?
We are. We are going to unpack a brilliant financial workaround to actually get your assets into that trust without getting crushed by the tax man.
Because that's usually the biggest hurdle.
Huge hurdle. And to guide us, we are pulling from a comprehensive brief on strategic financing for South African Trust Wealth Transfer.
And we also have some incredible insights from the website of Lumke Sturman.
Yes, she is a specialist trust consultant who actually architects these fortresses for business owners.
She really knows her stuff.
Okay, let's unpack this. Because to appreciate the genius of the solution, we first have to stare down the massive tax trap standing in your way.
It really is a trap, you know? When a business owner finally realizes they are fully exposed, operating as a naked entrepreneur, basically the immediate instinct is to protect those assets.
Right, you want to move them into a family trust.
Exactly. But the moment you actually try to execute that transfer, the mechanics of South African tax law hit you like a freight train.
Let's run the numbers on that freight train, just to be clear.
Let's do it.
Say you have a commercial property worth 10 million rand. You want it safe in your trust. Option 1, you just donate it.
But SARS levies a 20% donations tax on that transfer.
Right. So after a minor initial exemption, you are staring down a 2 million rand tax bill.
Payable in cash.
Payable in cash just for moving your own asset to your own trust. Nobody has that kind of dormant cash lying around.
No, of course not.
Yeah.
And historically, nobody paid it?
Because there used to be a workaround.
Yeah, before 2017, the absolute gold standard for wealth transfer in South Africa was the interest-free loan.
It was so common.
The mechanics were elegant, really. You would essentially sell your 10 million rand property to your trust.
But the trust doesn't have 10 million rand in cash.
Right, so it creates a loan account, it owes you the money, but since it's your family trust, you charge 0% interest.
Naturally.
The asset sits safely in the trust, appreciating in value outside of your personal estate, and you completely bypass the donations tax.
It was a beautiful loophole until SARS slammed it shut.
They absolutely slammed it shut.
They introduced Section 7C of the Income Tax Act, which fundamentally changed the landscape of wealth transfer in this country.
They targeted that exact mechanism aggressively.
How does 7C actually work for the people who might not have dealt with it yet?
So Section 7C dictates that if a natural person, like you, lends money to a trust at an interest rate lower than the official rate.
Which hovers around 8% right now.
Yeah, around 8%. Well, if you charge less than that, SARS steps in. They look at the shortfall between what you charged, which is 0, and what you should have charged, which is 8%.
And they just classify that missing interest as a deemed donation.
Exactly, a deemed donation.
So on a 10 million rand loan at 8%, that's 800,000 rand of interest you didn't charge.
Right.
And SARS treats that 800,000 as a donation every year. You get a 100,000 rand annual exemption, leaving 700,000 rand.
Tax that at 20%, and you are bleeding out 140,000 rand.
Oh, man.
And that isn't a one-off penalty either.
You pay it every year.
Every single tax year for the lifespan of the loan. If that loan sits on the books for 15 years, your annual tax bleed eventually surpasses the cost of just donating the asset outright on day one.
It is a slow financial hemorrhage.
It really is.
So it's like trying to move your money from your vulnerable left pocket to your secure right pocket.
Uh-huh.
But SARS has set up a toll booth right in the middle, and they charge you a massive fee every single year that the money sits in the right pocket.
That's a perfect way to describe it.
And if you think, well, I'll just charge the trust the 8% interest to avoid the penalty, you trigger a completely different landmine.
Oh yeah, the income tax landmark.
Right. Now, the trust pays you 800,000 Rand a year in interest, which is your personal taxable income.
And if you were in the top tax bracket at 45%, you are paying 360,000 Rand a year in income tax.
It forces the business owner into an impossible dilemma.
It really does. And this structural gridlock is why we have to shift our perspective to Lumke Sturman's core philosophy.
The asset protection fortress.
Exactly. The goal isn't just to casually move an asset. It requires rethinking the very architecture of your wealth.
So we need to construct the fortress from the ground up.
Yes. The golden rule here is absolute separation. Your company carries the risk, but your trust owns the assets.
Let's break down the vehicle driving this fortress. In South Africa, you generally look at testamentary trusts, right?
Which are born from your will after you die.
And living or inter vivos trusts, which you establish while you are still alive and running your business.
And we are heavily focused on the living trust here.
Because that is where the act of protection happens.
You're right. Once a living trust is properly established and legally owns your assets, an invisible wall goes up.
So if your trading business faces liquidation,
Or if a creditor comes after you personally, those trust assets are untouchable. You do not own them. The trust is a separate legal entity.
and there's a powerful secondary benefit too, isn't there?
Oh, massive. Because those assets are purged from your personal balance sheet, your estate duty is massively reduced when you eventually pass away.
You are shielding your wealth today and preserving the legacy for tomorrow.
Precisely.
I hear that, I really do. But I have to push back here on behalf of anyone listening who has spent decades building their business.
Sure, what's the concern?
Well, if I transfer my 10 million Rand commercial property into a trust, I am legally giving away my life's work. Why on earth would I surrender total control of my own money to an entity I don't technically own?
It's the ultimate psychological hurdle for any founder, I'll admit that.
It feels like jumping off a cliff.
It does. But the key is understanding the difference between legal ownership and strategic control.
Okay, unpack that for me.
You are surrendering the title deed, yes, but you are not surrendering the benefit.
Right.
Within a well-architected family trust, you typically act as a trustee. You are still sitting at the table making the investment decisions.
Deciding when to sell, determining how the assets benefit the family.
Exactly. You are still running the show strategically.
But the law requires a check on that power, which brings us to the independent trustee.
Yes, you can't just run the trust like your own personal piggy bank.
That is a critical legal safeguard.
South African law actually requires family trust to appoint an independent trustee.
Yeah.
Their strategic value cannot be overstated.
Because they bring objective governance.
Right. If you get sued and a creditor's lawyer looks at your trust, they're going to try and prove it's just an alter ego.
Like a sham setup where you still pull all the strings?
Exactly. And the independent trustee is your shield against that. They ensure meetings are minuted, resolutions are passed properly, and the trust acts like a true independent entity.
So you maintain the strategic direction of the wealth, but the independent trustee ensures the fortress walls hold up under legal scrutiny.
That's exactly it.
Okay, so we've built the fortress. The trust is ready to hold the assets, but we are still staring at the Section 7C toll booth standing over the moat.
The dreaded toll booth.
How do we get the assets inside without triggering that continuous tax strain?
Well, we change who funds the expedition.
Okay.
The legislation for Section 7C is very specific. It penalizes loans made by natural persons or connected companies.
So the breakthrough strategy is to step out of the financing equation entirely.
Yes. You bring in a registered financial institution, you bring in a bank.
Here's where it gets really interesting.
The mechanics flip completely.
How so?
The bank extends a commercial loan to the trust at a market-related interest rate. The trust takes that fresh capital and uses it to buy the commercial property from you at its full objective market value.
Because it's a registered bank charging a real market rate, Section 7C simply doesn't apply, does it?
It evaporates entirely.
Wow.
Yeah, the entire purpose of Section 7C was to stop individuals from using artificial 0% loans to disguise wealth transfers.
But a bank loan is a legitimate arm's-length commercial transaction.
Right. The bank isn't giving your trust a tax-free favor. They are in the business of making money.
Because there is no artificial shortfall in the interest rate, the abuse the law was designed to stop doesn't exist.
And SARS explicitly excludes these institutional loans from the penalty.
The end result of this maneuver is staggering when you map it out.
It really is. The trust legally acquires the asset, and the fortress is sealed. The bank earns its interest.
And you, the founder, you walk away with a massive injection of liquid cash.
That's the best part.
I really want to emphasize what a game-changer personal liquidity is.
Oh, absolutely.
If you do the old-school loan account, your net worth is tied up in stagnant paper. You can't use a loan account to buy a new business. You can't invest it offshore.
And you certainly can't buy groceries with it.
Exactly. But with bank financing, you have cold, hard cash in your personal account.
You can deploy that capital into new ventures, diversify your portfolio, or utilize your annual tax exemptions to slowly bleed that cash back into the trust over time.
Liquidity provides options.
It does. And in the context of estate planning, leaving behind a liquid cash reserve that your heirs can easily distribute
Or used to settle final taxes.
is infinitely superior to leaving behind a complex, illiquid loan account that will trigger estate duty complications.
Theory is easy, though.
Fair point.
How does this math actually hold up when a real entrepreneur tries to move a multi-million rand asset?
Well, the sources provided a fantastic case study about a business owner named Sarah.
Oh yeah, that proves just how powerful this is in practice.
Sarah's situation is the textbook application of this strategy.
So she holds a commercial property in her personal name valued at 12 million rand.
Right. And she acquired it 15 years ago for 4 million rand.
It's a great asset, generating what, 1.2 million rand annually in rental income?
Yeah, 1.2 million. Now she realizes the risk and wants to move it into her family trust.
Okay, if Sarah goes with the direct donation route, the math is brutal.
It's terrible. Because the property grew in value from 4 million to 12 million, she has an 8 million rand capital gain.
And she owes capital gains tax, or CGT, on that profit, which sits around 1.44 million rand.
On top of that, she owes the 20% donations tax on the full 12 million rand value.
So all told, she is wiping out about 3.82 million rand in pure taxes.
Yeah, the old interest-free loan method doesn't offer much relief anymore either.
She still triggers the 1.44 million rand in CGT because selling the asset to the trust is a capital gains event.
Right. But then she gets caught in the Section 7C net. On a 12 million rand loan, she is going to bleed about 172,000 rand in deemed donations tax year after year.
It's an endless liability.
It really is.
Let's run the bank method instead.
Okay, let's do it.
Sarah's trust approaches a commercial bank and secures a 15-year loan for 12 million rand at, let's say, prime plus 1%.
The trust hands that 12 million rand over to Sarah, and the trust takes ownership of the property.
Looking at Sarah's personal ledger, she still pays her 1.4 million rand in capital gains tax.
That is unavoidable whenever you dispose of a highly appreciated asset.
But because the trust paid her in cash, she nets 10.56 million rand in pure liquid capital.
And she holds zero loan account with the trust. Section 7C is completely neutralized. No annual tax bleed.
The math on Sarah's side is fantastic, but let's look at the trust. A critical listener is going to spot a huge logical gap here.
Which is?
How does a brand new empty family trust walk into a bank and get a 12 million rand loan?
Ah, yes.
Doesn't the bank force Sarah to sign a personal surety?
Which completely destroys the asset protection fortress.
Because now her personal estate is on the hook if the trust defaults.
Right. And that is the exact trap amateur planners fall into. It's why structure is everything.
So how do you avoid it?
If you sign a personal unlimited guarantee, the fortress is compromised. The way this is underwritten relies entirely on the asset itself.
Because the commercial property is generating 1.2 million rand a year in stable, verifiable rental income.
Exactly. The bank evaluates the strength of the lease agreements and registers a first covering mortgage bond directly over the property.
Ah, so the property is the collateral.
Yes. The trust's rental income services the debt. If structured correctly, the bank ring fences the risk to the asset, removing the need for a sweeping personal guarantee from the downer.
Okay, so the trust has the loan, but it's paying a significant amount of commercial interest to the bank over 15 years.
Yes, that is a real cost.
How does paying bank interest beat paying the Section 7C tax? Well, for two reasons. First, because the trust purchased an income-producing asset, the interest paid to the bank is an expense incurred in the production of income.
Which means
That means the interest is generally tax-deductible against the rental income the trust receives. It highly optimizes the trust's tax position.
so the rental income pays down the bank's debt efficiently.
Right. And second, introducing a bank introduces forced commercial discipline.
Which family loans notoriously lack.
Oh, completely. Family loans just sit on the balance sheet forever, gathering dust and generating tax problems.
But a bank loan comes with a strict amortization schedule.
It forces a disciplined monthly capital repayment. The trust is compelled to manage its cash flow.
Fast forward to the end of that 15-year term, the bank is paid off.
And the trust now owns a 12 million rand commercial property free and clear. It's generating unencumbered income for the family.
It is completely shielded from Sarah's personal business risks.
And Sarah's personal estate is protected from massive estate duties. She effectively transformed an exposed, highly taxable asset into heavily fortified generational wealth.
While extracting personal liquidity for herself today, it is a stunning piece of financial architecture.
It really is when it's done right.
But there is a massive caveat here, isn't there?
Oh, definitely.
Building a trust without a specialist is like trying to perform your own root canal using a YouTube tutorial.
It's going to end in absolute agony and a massive bill.
If you execute this poorly, SARS will tear the entire structure to the ground.
The regulatory risks are severe, and they require professional navigation.
Because SARS employs a general anti-avoidance rule, right, known as Section 80A.
Exactly. If they audit this transaction and determine it lacks genuine commercial substance, like if it looks like a sham just to dodge taxes, they can invalidate the entire structure.
Meaning everything has to be done at objective market value. You can't arbitrarily value a 12 million rand building at 6 million just to get a smaller loan.
No, you need professional, independent property appraisals. The trust deed itself must be expertly drafted to explicitly authorize the trustees to borrow money and pledge assets as security.
The trustee resolutions authorizing the purchase and the loan must be legally flawless.
And the lease agreements must be commercially sound to satisfy the bank's credit committee. It is a highly coordinated effort.
Which brings us back to the role of a trust consultant like Lomke Sturman. Her value isn't just in knowing the law, it's in seeing the entire board.
Because this strategy sits at the messy intersection of tax law, trust law, and institutional banking.
And a specialist coordinates all those moving parts.
They ensure the little documents satisfy the master of the high court, the tax strategy withstands a SARS audit, and the financial structure meets the bank's strict lending criteria.
You need an architect who translates between all those different institutions.
Yes, and Lumke's primary mission is to empower South African small business owners to proactively secure their family's future before a crisis hits.
She actually offers a foundation audit for 25,970 Rand, which does an exposure risk analysis.
Right, or the asset protection blueprint session for 39,990 Rand, which is a step-by-step custom trust and company structure.
So if you are sitting in traffic right now or listening at your desk and you suddenly realize your entire life's work, your business, your properties, your investments are sitting dangerously in your personal name.
Which so many are.
What is the literal first step you take today?
The first step is to get out of the dark. You need a comprehensive exposure analysis.
You have to clearly map out your personal risk versus your business risk.
And identify exactly where the vulnerabilities are before you can even begin drafting a trust deed.
So the most practical, immediate action is to visit www.lumkesturman.com and book an initial consultation.
Yes, you want to map out this fortress and understand your options well before a lawsuit lands on your desk or an unexpected audit freezes your accounts.
You cannot build the shelter once the hurricane has already made landfall.
That is the perfect analogy to summarize the stakes.
Setting up a trust in South Africa and navigating the complexities of Section 7C can feel like walking through a minefield.
It certainly can.
But when you understand the rules, and specifically how to leverage financial institution financing, you turn a massive tax liability into a profound strategic advantage.
You legally bypass the Section 7C drain.
You extract usable liquidity for yourself, and you place an impenetrable shield around the assets you've spent your life building.
It is the definitive shift from operating in a state of vulnerability to operating from a position of absolute strategic strength.
If you are ready to separate your ownership from your liability and ensure your life's work actually outlasts you, you can explore the mechanics of this strategy and book an exposure assessment directly at www.lumkasurman.com.
We've spent this entire deep dive focusing on protecting your wealth from outside threats, the creditors, the taxman, the volatile economy.
Right.
But I want to leave you with a final thought to mull over. A properly structured trust doesn't just keep the bad guys out. It protects your legacy from inside threats.
Oh, it's interesting.
Think about it. How much generational wealth is squandered simply because the next generation wasn't emotionally or financially equipped to inherit a massive lump sum of cash?
So true.
If that wealth was held in a trust, it could have provided steady, protected guidance, paying for education and funding businesses instead of funding reckless mistakes. So ask yourself, are you just stockpiling wealth for today? Or are you actually building a legacy equipped to survive you?